All right then, so we'll get started. So first of all, welcome to everyone who is attending our seminar this evening. Thank you very much for coming. My name is Shannon Dwyer. I am the digital banking strategist for Dutch Point Credit Union, and I will be one of your hosts for the seminar this evening. And I would like to introduce our other host for this session, Lori Morningway. Hi, Lori.
Hi, how are you, Shannon?
I'm wonderful. Thanks so much for being here tonight.
Thank you.
Lori is our Lending and Business Development Officer here at the Credit Union, and we are excited to have her as part of this seminar. So thank you again. And we're looking forward to sharing some awesome information with you. We do have one quick housekeeping note before we get started. We have enabled a chat and a Q&A feature on this session for you to submit any questions. And if you do have any questions, please do feel free to submit them. We will do our best to answer them at the conclusion of the presentation. But if we are unable to answer any of the questions you submit, please know that we will follow up with you after the session is over, okay? So with all of that said, let's get to it. We're just gonna do a couple of adjustments here. And we'll get this started. Okay, Lori, take it away.
Great, thank you again, Shannon. I'm really happy to be here and I'm looking forward to going over this presentation with all of you on basic banking. So our seminar objectives today, we're going to go over several topics. The first is checking and savings account basics. Using debit cards wisely. We're then going to go over setting savings goals, then budget basics, establishing credit the right way, and we're going to save questions again to the very end. So basic banking terms, we're going to go over some very basic terms. The first is an account. What is an account? It's a financial property you own under your name. Examples of that would be a savings account and a checking account. The next would be ACH and electronic debits. These are electronic payments from your account. You would set these up on your own to pay things like your gym membership, auto insurance. So instead of you writing out a check or calling that company to pay that bill, you would prearrange to have those payments come directly out of your account. The next is direct deposit. That's money that's automatically deposited to your account from your payroll company, from your employer. Clear. Clear is when money for a transaction is removed from your account or deducted from your account. So for instance, if you are writing out a check and it's for a credit card bill for $30, when that check is presented to the institution and it's deducted from your account, we call that cleared from your account. Hold. Holds are when funds are delayed while the transaction, whether it be a deposit or a withdrawal, is being processed. An example would be you're depositing a check and there happens to be a hold on it for whatever reason. The funds are not available, so there's a hold until that check clears from the other institution where it's drawn from. Transfer. Transfer is when you move money between your accounts. So you want to transfer money from your savings to your checking, that would be a transfer. Routing number. A routing number is a unique bank identifier to direct money to a specific institution. So all banks have a specific number that's known just to them, and that they use a lot for direct deposit. The next is I'm going to go over some accounts that you will have throughout your lifetime. The first being a basic savings account. A savings account is meant for that, just savings. It's easily accessible if needed. Your savings account earns interest on the money that you have in that account. A savings account is where you would pay yourself first. What I mean by that is you would treat yourself as a bill where you set so much money aside to put into that savings account for future savings, emergencies. A savings account is also where you would set up direct deposit allocations from your employer, again, to allow so much to go into that savings account and so much to go into another type of an account that I'll get into shortly, which would be a checking account. The savings account is also an account that you would save for emergencies, rainy days, holidays, vacations, something that you know that you want to save for, and you're setting aside a certain portion just in case. The other type of account that is very important that you'll have for the rest of your life would be a checking account. And a checking account is an account, we call it a transaction account, and that's where your money would be used when you're making purchases or payments to companies. You can access the money in the checking account several ways. You can go to an ATM and do an ATM withdrawal. You can use a debit card to make purchases. You can do online purchases by using your debit card, and you can also write out checks. There's limits on what can be withdrawn from your checking account, and you can withdraw only what is available. And I'll go through that shortly. You can again access your ATM, your money through an ATM with withdrawal limits. And what I mean by that is how much you can withdraw at an ATM. And then there's debit card purchases. That's how much money you can spend in one particular day on purchases. So a debit card is associated with your checking account. It's your own money. It's not a credit card, but it can be used where credit cards are accepted. You can use it at an ATM to withdraw cash from either your checking account or your savings account. The funds must be available in your account to use them. So you can use your debit card as a debit transaction or a credit transaction. When you use it as a debit transaction, you are going to enter a PIN number, which you would assign. You would set that PIN number up yourself. It's a unique number. And the money from your account comes out immediately. The other way that you can use your debit card is as a credit transaction. That's where you would sign for the purchase, the money is put on hold, and withdrawn a few days later. You want to make sure that the funds are available from your account immediately. And you also want to know that you're spending, and you want to keep track of what you're spending. So when I talk about what's available and what's current, a current balance is the total amount of money that's in your account. That means even if you wrote out a check and it has not been withdrawn from your account, that is the current balance. The available balance is the amount of money you can actually spend. What I mean by that is sometimes Let's say you have a check, you come to the branch and you deposit a check, and there might be a hold on that account, that check, before it clears. That would be, so it's the amount maybe less than your current balance if there's a hold or a pending transaction from your account. So you always want to look at your available balance when you're checking your account balance. The available balance is the money that you have available for you to spend. You never want to spend more than what's available. So we've come up with some benefits of managing your money. A great one is free up time. So when you free up time, you can enjoy things. You do things that you enjoy. You also have less stress. By having less stress, you have better health, less worries. When you manage your money, you can achieve goals and you also feel satisfied. You also have greater control. You have peace of mind, knowing that you're on the right track for your financial goals. You want to set SMART financial goals. Your goals should be specific, measurable, attainable, realistic, and timely. And I'm going to go through each of those goals. So specific, what you want to do is include as much detail as possible. You want to ask yourself, what am I striving for? How will I achieve it? Who does it involve? And why is that goal important to me? So an example, I'm striving for a new auto. I want to buy myself a car. How will I achieve it? I need to save money. Who does it involve? It's going to involve myself. And why is it important to me? Because that's the transportation that I'm going to use to and from work. I'm going to need a car to get to work. So that's why it's important to me. Your goal should also be measurable. Benchmarks are a must. What you want to do, an example would be, I want to save $1,000 by the summer. When you say by the summer, it should be, you have to set a date. So let's say we're going to set a date for September 1st. Your goal has to also be attainable. So can you reasonably accomplish saving $1,000 by September 1st? What I would do is count how many weeks we have until September 1st. It's $1,000 goal. That would mean that I would have to save about $71 a week. Ask yourself, can I really save $1,000 a week? Is that a realistic goal? If it's not, you either then have to change your measurable mark to either a lesser dollar amount or extend the date past September 1st to attain that goal. Your goal needs to be timely. Again, if you can't reach that $1,000 by September 1st, either lower that dollar amount or extend the time frame. There's 3 sets of goals. So before you do anything, you want to determine what you're saving for. Is it going to be a short-term goal, a goal that's going to be reachable, attainable within the next 12 months? Or is it going to be a medium-term goal, a goal that's going to be attainable within 1 to 5 years? Or is it going to be a long-term goal, a goal that is going to be more than 5 years away? So you're going to set a goal and determine what bucket it's going to fall into. So once you've determined what you're saving for, you need to know the difference on how you're going to achieve those goals. It starts by knowing the difference of what a budget is. A budget is to save, budget, and invest. So a budget, you're going to, again, do your short-term goals within the next 12 months. That's where you would be saving for, again, an emergency fund. That money would be in your savings account, or other living expenses or regular gas money on a weekly basis. You then want to save for goals that are 1 to 5 years out. That would be when you want to buy a car, or you're saving for your first apartment. You know that in the next 1 to 5 years, you're going to be moving out, so you want to save for your medium-term goals. And invest for your long-term goals, again, which are 5 years or more. That's when you're going to be thinking of maybe tuition for grad school, or maybe paying off a student loan, or maybe saving for your first home. By doing that, how you're going to accomplish that is you're going to create a spending plan or a budget. A budget is a blueprint for your day-to-day personal finances. Its purpose is to plan, organize, and improve your financial situation. So a budget starts with two key components. The first being income, and that's all the money that comes in. And the second being expenses, all the money that goes out on all of the bills that you're going to have. So once you create a spending plan or a budget, it allows you to stay on track financially. You're going to know, because you're going to track, whether it be daily, monthly, where you're spending your money and how much comes in. It's also going to decide on where your money goes, because you're going to have a plan of what comes in and what goes out. And if you have more that goes out than what's coming in, so more expenses versus more income, you need to reallocate your expenses. And then you can make more informed choices by reallocating or changing your habits. You need to determine whether you're living within your means. Again, you can't have more expenses than the income that's coming in. You also want to develop a savings plan where you are the most important bill out there. So you want to make sure that as you have income and you're looking at your expenses, you are putting money into a savings account just like you are paying a bill, and you are thinking of yourself as that bill. So whether you put in $5 or $10 into that savings account, that is your forced way for you to save money. A spending plan also controls your financial future, where again, you would have the freedom to make choices for things that will get you on your financial way. There are 5 steps to a successful spending plan. So the first is you want to list all the sources of income, whether it be a job, birthday cards, you get birthday checks, anything that you receive as a source of income. Then what you want to do is determine where your money goes. And we break down where your money goes into 3 expense categories. The first is fixed expenses. The second is variable expenses. And the third is periodic expenses. And I'm going to go through each of them. So fixed expenses are expenses that have the same payment amount every month. An example would be rent, So you are renting and your landlord says that you are going to be paying the landlord $500 a month. You know for the time frame of that lease, $500 is the same payment every month. Or when you go and purchase your new vehicle, your loan payment on that auto is going to be the same payment every single month. So those are fixed expenses. Variable expenses are expenses that change on a monthly basis. So examples would be a grocery bill. You never are going to spend the same dollar amount every single time that you go grocery shopping. Or when you go out to eat, you're not going to be spending the same dollar amount. So those are variable expenses. And periodic expenses are expenses that do not occur on a regular basis. So it might be car insurance. Car insurance, normally you pay every 3 months. There are times that you can pay your car insurance off yearly. What you need to remember is that all of these expenses you need to keep in your budget and plan for those, so that when your periodic car payment comes in 3 months from now, you want to make sure that you have saved for that car insurance payment. The third spending plan would be balance income and expenses. Again, you don't want to have more expenses than the income coming in. And if you do, you either need to increase your income, and sometimes that's not always easy, but you definitely have the option to lessen those expenses. 4 is review income and expenses. So if you see that, again, your expenses exceed your income, you need to adjust your spending plan. And that might be the case. It might be every 2 months that you might have to readjust. And it might take some time to adjust that plan to be successful. And you want to manage your system. There are various methods to tracking your spending. The first, probably not that common, is you want to retain all of your receipts, probably in an envelope, so that you can then put maybe on the envelope January expenses. Put all those receipts in that envelope, and then you can at the end of the month look at them and just add them up and see if everything looks good. The other way is mobile banking. What you want to do is download your financial institution's mobile app, log into your account on a daily basis, and review your transactions and review your balances. The other way that you can track your spending is through a computer program. You can log in and track your money. Examples of a computer program would be examples like Quicken or Mint. There are programs out there, again, that you would log in. It would automatically fill in, and you would track your system that way, your money habits that way. Another way would be a spending worksheet, like an old-fashioned balance sheet. What comes in, what goes out. Another way would be transaction, text, and email alerts. So what you would want to do is sign up for text alerts, and you can indicate, I want to know when my balance falls below $100. When your balance falls below 100, you would get a text transaction or an email alert saying your balance now is $89. That will alert you to say, oops, I need to put money from my savings account into my checking account. Another way that you can set up an alert would be setting it up for a certain transaction dollar amount. So you want to put in, I want to track any transaction that comes into my account over $50. What that would mean is any transaction that posts to your account over $50, you would get an alert stating transaction for gym membership came out on such and such a date. It would also alert you to say, ooh, do I have enough money in that account for that payment to come out? Examples that drain your budget dry, and I'm sure we've done this one time or two times in our lives. We left the water running. We left lights on. We go shopping when, impulse shopping. We don't really need anything, but we just want to do something and we want to go spend money. Eating out frequently. Paying late fees is a big one. Ignored repairs. I know I have to get my car fixed, but I'll wait another 2 weeks. In that 2 weeks, now more repairs happen. Leftover food. Parking tickets. Speeding, quick car acceleration, that has your gas go faster. Some practical money savings tips. These are just a few. Send in rebates and use coupons. Don't go shopping when you're hungry, you're mad. Brown bag it. Bring lunch to work or school. That'll save substantial. Average lunch, $10 a day times 5. Think about how much money you could be saving. Adjust the thermostat and use ceiling fans. Again, drive sensibly to save on gas. Make savings a habit. Don't commingle your spending money with your bill money. Create budget accounts. And you can create several. You can have, here at Dutch Point, you can have little what we call sub-accounts to do savings, car payment, rent. And you can allocate so much money to go into each of those accounts so that when that monthly bill comes in, that money is right in that sub-account titled car payment, titled rent. And use credit cards wisely. So some tips for your paycheck. First job or opportunity to earn some money. What you want to do again, and I keep on stressing this, is you want to pay yourself first. Again, treat yourself as a bill. Have some of your paycheck direct deposited into your account and let us automatically help you save. Putting aside $10 a week. Again, allocate so much money into that account. So here, if we did $10, it adds up $520 at the end of the year. Out of sight, out of mind. I do this myself. I start a change jar. I know it sounds crazy, but at the end of the week, my purse is full of change, weighs a ton. I empty my purse, put it in the change jar. Empty your pants pocket at the end of the day. Put that change right in that jar. And then when it fills up, deposit that into your savings account. Another way for you to have forced savings. So now I'm going to turn it over to Shannon, and she will be going over establishing credit the right way.
Awesome. Thank you so much, Lori. There was so much great information that you've just gone through, and I know myself definitely got a lot of value out of it. So thank you so much.
You're very welcome.
All right, so I am going to spend a few minutes talking to you about establishing credit the right way. So first, I want to talk about why credit matters. Credit provides someone with information about your financial stability. It can determine your ability to get things. Examples like loans, credit cards, an apartment, a car, insurance for that car, or a phone. Now, something that comes up often when we're talking about why credit matters in your credit report is who can view my credit report. And it's important to know that lenders, landlords, insurance companies, phone companies, even potential employers, they all can view your credit for services and potentially make decisions on what you are offered based on that credit. So it's important to keep that in mind. Your credit can also determine your interest rates, excuse me, on loans. And this ends up being the price you pay for that loan. So ultimately, that can also impact your monthly payment. The higher the interest rate, the higher the potential monthly payment. And finally, credit positions you for financial success. Building and maintaining positive credit will save you money, and it will give you peace of mind knowing you have the ability to access funds when you need them most. So now that we've discussed why credit is important, let's talk about the best ways to build your credit the right way. So the first tip we'll provide in building credit is to start small. When you're first starting out with credit, your main goal is to simply show good repayment history. You don't need a huge loan or a credit card with a high limit to do that. All you need to do is to start with something small and make sure to pay it on time. And speaking of paying on time, good, consistent payment history is the most important part of your credit. Just one single late payment can have a big impact on your credit. So always make a point to pay your credit on time, all the time. The next tip is to plan ahead. So let's say I know I'm going to want to buy a car in a year or two. If I'm new to credit, I need to start building positive credit now so that in a year or two, when it's time for that car, I'll have some credit established. When I go to buy that car and get a loan, my lender will want to see some credit history. And they'll use that to make a decision on whether I can have a car loan and for how much I'll be approved. And that credit I've established, again, will have an impact on the price I pay for interest on that loan and ultimately impact my monthly payment. Another tip, when it comes time for you to start taking out some credit, you may want to consider asking a parent or a family member to co-sign on that loan with you. Having a person with already established good credit be a part of a loan with you can make a lender feel more comfortable about giving you money, since you won't really have any credit yet established, but they do. Now, some lenders, including Dutch Point, offer what's called secured loans and credit cards. The reason why they call them secured is because you use money you have in savings as a security interest in the loan or in the credit card. Secured loans are a fantastic way to start building credit. Basically, you would take out a small loan, $500 for example. You use that amount of money you have in savings as the security for the loan. The money gets placed on hold while you have the loan. And every month when you make your minimum on-time payment, the amount of your monthly payment becomes back available to you in your savings account until you finish paying off the loan and all the money you put aside for it is back available to you. The interest rates on secured loans are also very low. So you'll only pay a small amount of interest, which is good because you're just trying to get some credit established for yourself and you're going to save some money. Another great way to build credit is with credit cards. Credit cards are super useful in building credit when used the right way. You can get a credit card from your financial institution like Dutch Point, or you can even get a small credit card at a store you like to shop at. So let's take a moment to talk about credit cards specifically and what they mean and what they can do for you. So what exactly is a credit card and how does it work? Well, a credit card allows you to buy things. It's a way to pay for goods and services. When you get a credit card, you are granted a limit, meaning you have this line of credit available to you up to the limit that you get approved for. When you buy something, the charge is made against that line of credit. It does not deduct the money from your account like a debit card would. Each month, you will receive a credit card bill that will show the charges you made that month and the payment that's due. It will also show you the total balance of what you owe on the card, as well as what your limit is and what you would have available to you if you subtracted your total balance from your limit. Now, we recommend, especially when you're new to credit and building credit, that you pay off the total balance owed each month, rather than just paying the minimum payment due. Now, why is that? When you pay off the total balance in full each month, you avoid paying any interest on the card, which saves you money. Another tip to save money and help in your quest to build that credit: always make your payment on time. And this will help you avoid any late fees. When you're new to credit, we have a strategy at Dutch Point that we recommend you follow when you get your first credit card. Now remember, the goal here is to build and establish credit. And in order to do that, you have to use something like a credit card, because that reports your usage and your payment history to the credit reporting agencies, the ones who make your credit report and build your credit and show your credit for you. But you want to make sure and use the card wisely. So here is what we recommend. Each month, buy one thing on that credit card. Go out to dinner with friends and charge it on the credit card. Fill your tank of gas. Buy a shirt or a piece of clothing. Some kind of charge on that card. And it doesn't have to be a lot, just something. Make sure what you do charge, though, is never more than 25% of your total credit limit available, when you're building credit. 25% of your total credit limit. Never spend more than that. That will make sure that you are building your credit in a positive way. So for example, if your credit limit is $500, never charge more than $125 in 1 month. Then, once you get your monthly bill, pay off the balance in full. So your balance goes back to zero and your entire credit limit is available to you again. Now, it takes time to establish credit. And usually we recommend you follow this model for at least 1 year so you have some credit established. But following this recommendation will help you establish good credit right from the start and set you up for future financial success. So other than credit cards, what kind of loans are available that can help you build credit? Well, there are lots, and Dutch Point has a number of options available to you. We're going to cover a couple of them here. Secured loans. So again, a couple of slides ago, we discussed secured loans. They're a great way to build credit when you use your own money and savings as a backer for that loan. You never lose any of your money in savings. You simply offer it up as something that can be placed on hold while you have the loan. Once you pay off and close the loan, or close the credit card, for example, all of that money you put aside for getting that loan becomes available to you again. Then we have low limit credit cards. They do not have funds secured. So this is like something you would graduate to after having a secured credit card. And unsecured means that you don't have to put any of your savings money on hold in order to get that card. And the interest rates, if you weren't able to pay it off every month all the way, the interest rates are low. Then we offer what's called a first-time car buyer loan. This is a great loan option for you when you go to buy your first car. There are some criteria you need to meet in order to be eligible. And one of our lending specialists at Dutch Point can go over those things with you when you're ready to talk about this option. But it's a great loan with a low interest rate that is designed to help you get your first set of wheels easily and affordably. And then also, we offer family pricing on car loans. Family pricing comes into play when you take out a loan with a parent or family member as your co-signer, something we discussed also a couple of slides back. And what we do is we end up pricing that loan, meaning offering the interest rate you'll pay on that loan based on the better of the credit, which is almost always the other family member's credit, because as a young person, you won't really have much established yet. So this is a great way to save money on that loan and help yourself build credit thanks to the support of your family member. So those are just a few options. You know, many lenders offer the same sorts of things. Those are the things that Dutch Point offers to help you build credit and establish credit. But you always want to remember, at every stage of life, your credit union is here for you. We know student life can be hectic, but we're here to provide you with a variety of tools for simple money management so that you can concentrate on your education while easily building your financial future. Because that's what it's all about, building for the future. So that concludes our presentation. Let's just take a moment to stop sharing the show and we'll get back on video here for you. Lori, that was fantastic.
Thank you, Shannon.
So we have time for a couple of questions. Let me just see what we have over here. So we do have a couple of questions. The first one that we have, Lori, how much do you recommend I save for a down payment before I go to buy a car? Great question.
Great question.
Great question.
So, first of all, I would recommend at least 20%. But what I also want to say is you want to make sure that the car and the car payment is within your means. So your first car does not need to be a $30,000 car with a $800 payment. You need to look at your budget or your spending plan that you had set up when you started this process. Again, it's got to be affordable for you. Think about insurance as well, as it's not just a car payment. There's insurance that comes with it. There's gas that comes with it.
Absolutely.
So you need to put all of those factors into your spending plan and be reasonable and realistic. So I again recommend going to the original question. I would say at least 20%. And from a lender's point of view, I think that the lender would look more favorably on that, knowing that you as an individual have a means to save as well. They look at you more favorably.
Excellent. Great advice, Lori. Great advice. Thank you.
You're welcome.
All right, let's see. We have another question. Oh, here's a good one. Okay. Will getting multiple credit cards increase my credit score? This comes up a lot. What do you think, Lori?
I think no, that's a big no-no.
No.
So people assume that the more credit they get, that's going to build faster their score, when in reality, it does just the opposite. From a lender's point of view, when they see that you're opening up too much credit, they think of you more as a risk. Why are you trying to get 20 different store cards? You really only need major credit cards, so do 1 or 2, and that's really about it. And also keep your limits within your means as well.
Right. Yep.
And as Shannon said, when you're starting off on credit, you want to only use 25% of that limit, and we call that capacity. So if your limit is 500 and you're spending 500, from a lender's point of view, they are saying, oh, they're tapping it out, they're capped out. So you don't want to shop credit. You want to be 2 or 3 credit cards with smaller limits. 25% of your limit is all you want to spend. You want to make sure that you pay it off in full, have a good payment history. Keep that card for a year. And sometimes lenders do automatic increases with positive payment history as well. So keep that in mind. You don't need to go out again and get 6 credit cards just to build your credit. Building your credit starts with you and how you're going to make that payment history. Are you going to pay it on time? Are you going to pay the balance off? Are you going to have late fees? It all depends on you and how you're going to manage that credit card. So you are really in control of creating good credit.
Wonderful. Wonderful. Well, I learned a lot just from that one question alone. So thank you.
You're very welcome.
One final question I see here. Does Dutch Point offer any student loan options? I can field that one. Dutch Point has partnered with CU Credit Union, CU Student Choice. They are a provider of some unique and flexible student loan options. If you have some interest in reading up about what they have to offer, they also offer seminars online on their website and everything like that. Reading materials that you can talk about, best practices when going off to college and taking out student loans. You can go to our website, our Dutch Point website, and under the borrowing section, there's a whole area about student loans and information on CU Student Choice for you to link to. So, looks like that's it for our questions this evening. So once again, Lori, thank you so very much for joining me here this evening.
You're so very welcome.
And to everyone who is attending this evening, thank you so very much for attending. We hope you got some really great information out of it. If you have any questions or anything you want to talk to us about after this session, please feel free to reach out to us. Other than that, we say goodbye and we wish you a wonderful evening. Thank you for coming. Have a great night.